The Q3 delivery number looks massive, but it's not what it seems. Tesla just beat consensus, and Wall Street is cheering. But here's the reality. This so-called victory is an artificial high. The expiration of the $7,500 tax credit pulled the rug forward. And the real story is that Q4 will be a demand crater. Today is Tesla's Q3 delivery day. Consensus expectations sat around 447,000 vehicles, while some of the most aggressive forecasts pushed toward 495,000. On the screen, you can see the consensus versus actual bar chart. It's a clean beat. But what really matters is the why. Because when you peel back the number, the shine fades quickly. Let's put this in perspective. To really understand Q3, we have to rewind the clock to Q2. That quarter was, to put it mildly, a disaster for Tesla's delivery numbers. They managed to deliver only 384,000 vehicles globally. This wasn't just a minor miss. It was a significant disruption caused by a perfect storm of factors. We had prolonged factory shutdowns at Giga Shanghai due to lockdowns, persistent supply chain bottlenecks affecting key components, and a general cooling of consumer sentiment amid rising interest rates. The result was a production and delivery logjam that artificially suppressed the numbers. This drop made Q2 the weakest sequential performance Tesla had seen in over 2 years, representing a steep 18% decline from the first quarter. Looking at this multi-quarter trend chart, you can see it's not just a dip, it's a canyon. The growth narrative that had been so consistent for Tesla suddenly hit a wall. This set an incredibly low bar for the following quarter to clear. And clear it, they did. On the surface, Q3 looks like a heroic comeback. The headline number of 435,000 deliveries sparked a wave of positive commentary. It represents a nearly 14% jump from Q2. So yes, if you only look at these two data points in isolation, Q3 appears to be a story of a strong, V-shaped recovery. But this is where context is everything. As I'm showing here in the delivery trend line, this impressive-looking bounce is largely a statistical illusion known as the low base effect. When you start from an abnormally low number like Q2's, any return to normalcy will look like spectacular growth. It's like getting a 50% on a test and then an 80% on the next one. It's a huge improvement, but you're still not back to the 95% you were getting before. The strength is more a reflection of the prior period's weakness than it is of new, underlying momentum. In fact, if we smooth out the volatility by looking at the year-over-year growth rate, a more concerning picture emerges. While Q3 deliveries were up from Q3 of the prior year, the rate of that growth has been steadily decelerating for several quarters. The long-term trajectory is flattening. The rebound simply brought deliveries back toward the pre-existing and slowing trend line. But even this low base effect isn't the full story. It explains the mechanics of the bounce, but not the driver. Here's the uncomfortable truth that gets lost in the headline numbers. This quarter's apparent success wasn't powered by a sudden surge in organic, sustainable demand. Instead, a significant portion of these sales were pulled forward from the future, driven by a powerful but temporary external catalyst. To understand the real health of Tesla's business, we need to dissect exactly what that catalyst was and how it distorted the picture. It was powered by a stopwatch. The $7,500 federal electric vehicle tax credit expired on September 30th for several Tesla models. That created a massive rush to buy before the deadline. On screen, picture a calendar flipping to that date. It's the only number that mattered. Let's break down the mechanics of what happened. At its core, this is a story about rational consumer behavior. Imagine you're in the market for a new car. You've done your research, you know the model you want, and you're planning to buy sometime in the next 6 months. Suddenly, you're presented with a concrete, unmissable deadline. If you complete your purchase by September 30th, you save $7,500. If you wait until October 1st, that money is gone. It's not a discount, it's a cliff. For most people, this isn't a difficult decision. The certainty of that financial gain, or more accurately, the certainty of avoiding that financial loss, creates an overwhelming sense of urgency. You'd move heaven and earth to get that deal done. Now take that individual decision and multiply it by tens, even hundreds of thousands of potential buyers who were in a similar position. The result is a massive coordinated rush to the checkout line. In economic terms, what we witnessed was a textbook example of high demand elasticity. The demand for these specific vehicles became incredibly sensitive to this time-bound price signal. That $7,500 represents a significant percentage of the vehicle's total cost, making the incentive far too large to ignore. It effectively compressed the natural buying cycle. People who might have bought in October, November, or even December all had a powerful, rational reason to pull their purchase forward into Q3. And this isn't some new, unprecedented phenomenon. We have seen this exact pattern play out time and time again. Look back at the Cash for Clunkers program in 2009. It created a massive temporary spike in auto sales, which was immediately followed by a payback period, a slump where sales fell below the normal trend line. We saw similar dynamics in European markets like Germany and the Netherlands when their generous EV subsidies were reduced or phased out. Registrations would skyrocket in the final month before the change, only to crater in the month immediately following. History provides a clear roadmap here. When you introduce a significant, time-limited subsidy, you don't create sustainable, organic demand. You are simply borrowing it from the future. The bigger the incentive, the more demand you borrow, and the larger the subsequent hangover will be. So when we look at the data, that's precisely what the chart shows. The narrative that this was a blowout quarter driven by a fundamental surge in demand is misleading. In reality, a significant portion of Q4's demand, and likely even some from Q1 of next year, was artificially pulled forward into Q3. This chart, with its bloated Q3 bar and the resulting slump in Q4, visualizes that distortion perfectly. It's not a picture of healthy, sequential growth. It's a snapshot of a one-time market dislocation, an accounting anomaly driven by a policy change. Understanding this pull-forward mechanic is the single most important key to accurately forecasting what comes next, and why the headline number, on its own, tells the wrong story. And this is where the forward-looking risk comes into sharp focus. The impressive Q3 delivery number wasn't purely a function of organic, sustainable demand. A significant portion was artificially pulled forward from the fourth quarter. The primary catalyst was the anticipated reduction of federal tax credits in the US for certain models, creating a powerful but temporary incentive for buyers to accelerate their purchases before year-end. This isn't free growth, it's borrowed growth. Because when you front-load demand so aggressively, the next quarter inevitably pays the price. Think of it as creating a demand vacuum. Consumers who would have naturally purchased a vehicle in October, November, or December were incentivized to act in September. This dynamic creates a significant air pocket in the demand curve, one that is difficult to fill, especially when the macroeconomic environment remains uncertain. We've seen this pattern before with subsidy changes, and the hangover is often severe. My Q4 model, which incorporates historical data on post-incentive fall-offs, paints a concerning picture. The base case scenario, shown here, suggests a steep decline in global deliveries, but the bear case, which I believe is increasingly plausible, points to a potential drop below 400,000 units. This isn't just a minor sequential dip. It's a sharp reversal of the growth trajectory that the market has come to expect from Tesla. That's not just a miss. That's a crater relative to the street's current expectations, which are hovering closer to 475,000 deliveries. Many analysts seem to be underestimating the sheer magnitude of the Q3 pull forward, anchoring their forecasts to the headline, "Beat." They're looking in the rearview mirror, while the real story is the cliff that might be appearing right in front of the windshield. Now let's zoom in on the regional data, because the picture gets even more complex. In Europe, the demand story has been weak for several quarters, and Q3 was no exception. August registrations were particularly soft, and while September saw the typical end-of-quarter push, the data doesn't rescue the overall picture. The continent is grappling with its own set of headwinds, from sluggish economic growth to intensifying competition from legacy automakers who are finally rolling out compelling EV alternatives. If you look at this regional breakdown, you'll see significant challenges in key markets. Germany, France, and the UK are all flashing warning signs. Even Even the launch of the refreshed Model 3, codenamed Highland, hasn't been enough to reignite broad-based momentum. While the new model created some initial excitement, it hasn't offset the underlying softness. Tesla is still struggling to find a sustainable growth footing in Europe. The glaring exception to all of this is China. Here, the story is completely different. Instead of weakness, we're seeing a powerful acceleration. Weekly insurance registration data throughout September showed a consistent and impressive ramp-up, culminating in a massive final week of the quarter. This isn't an artificial pull forward, it's a reflection of genuine, robust demand. This strength is fueled by a combination of factors. Recent price cuts have made the vehicles more accessible, Giga Shanghai is operating at an incredible level of efficiency, and the local consumer appetite for EVs remains incredibly strong. The question for investors, however, is whether China's phenomenal performance can single-handedly compensate for a deep demand vacuum in North America and persistent sluggishness across Europe. Right now, my analysis suggests it might not be enough to prevent a significant Q4 miss. Weekly registrations in September accelerated into the end of the quarter. On screen, I'd highlight the rising weekly bar chart. Shanghai kept the factory humming, and local incentives still help. But let's be honest, China's strength only masked the broader weakness elsewhere. So, what does this mean for investors? The Q4 earnings print is at risk. Even if gross margins hold steady, volume loss hits the top line. And with Tesla's stock priced for perfection, that gap could sting. On screen, imagine an earnings waterfall chart, showing how lost volume erodes revenue before margins even come into play. So here's the takeaway. Yes, Q3 looks like a win on paper, but it's a short-term illusion. The $7,500 incentive expiration turned one quarter into a sugar high, and now Tesla faces a demand hangover. For long-term investors, that's not strength. That's a flashing red warning sign.